President Trump targeted the Fed once again in his welcoming remarks at Davos over the week and seemingly encouraged the central bank to adopt a negative rate policy. But what does that actually mean for all of us? It's time for Yahoo U. Yahoo Finance's Cheung is here with this week's lesson. Brian?
Well, class is in session, and today we're breaking down the basics of negative interest rates. In Davos just this week, President Trump reiterated his call on the Federal Reserve to push borrowing rates into the negative. Take a listen.
They're forced to compete, and we compete with nations that are getting negative rates, something very new, meaning they get paid to borrow money, something that I could get used to very quickly. Love that. Got to pay back your loan? Oh, how much am I getting?
Trump was referring to the few corners of the world that currently have negative interest rates, like Japan, the Eurozone, and Switzerland. And Denmark actually also had a negative interest rate on certificate of deposits until last month. And also Sweden had negative interest rates. Now, these are the interest rates set by the central banks in these countries. The Sveriges Riksbank, that's in Sweden, was actually the first to implement such a policy in 2009, followed by the others between 2014 and 2016. But the rates that you see here are largely interest rates between banks and the central bank. So when rates go negative, does that mean that you'll see negative rates on your bank deposits? Or how about your car loans or mortgages? Well, let's start off conceptually with the broad idea of interest rates. So here in the United States, we are still in a positive interest rate environment. The Federal Reserve pays interest on money that banks park at the central bank by JP Morgan Chase or Citibank, for example. And currently, the effective interest rate between the Fed and the banks is 1.55%. Now, this sets a benchmark for how banks pay depositors for leaving money at the bank. So that bank may turn around and then pay 1.55% to Julie, who has a 9-month certificate of deposit, for example. But again, the 1.55 is actually just a benchmark. So I was looking across the street, for example, and a community bank here in New York was actually paying 1.85% on a 9-month CD. So to compete for deposits with other banks, some shops will actually bid up the interest rate to attract the Julies of the world that are looking to park their money. So then what happens in negative interest rates? Well, here we have Adam in a country that has negative interest rates of negative 0.5%, like in the Eurozone. Now, in theory, this means that the central bank is charging a bank 0.5% to leave the money with them. Now, this clearly creates a disincentive to deposit money. I mean, it would be better off for the bank to then lend the money out instead of leaving it at the central bank. So in turn, the central bank will turn to Adam and say, we're going to charge you 0.5% for leaving the money with us. But again, just because the bank is paying 0.5% to the central bank doesn't necessarily mean that the rate will transmit to consumers. So, for example, in Switzerland, UBS is actually only applying negative rates to clients with more than $2 million in francs. That's about 2.06 million US dollars. So, Adam, if you don't have that kind of money, you're not going to have to pay that charge. Now, why would a central bank do this? Well, in theory, it's to boost economic activity. So again, we'll use Adam. Adam is currently being penalized to park money at the bank. And if negative rates actually hold over to rates on loans, maybe that means the bank will pay 0.5% for a customer to take a loan out. So go out and spend, right? Go buy a house, go make a business investment, go buy that Studebaker Speedster in Hialeah Green that you've always wanted. And this is actually possible. So in Denmark, we've seen some negative interest rates on some mortgages. And again, this is the point of negative interest rates, to spur more lending to boost economic activity. So if banks and consumers are penalized for saving money, that should in theory boost growth in times where an economy may be faltering. But this raises a bunch of questions. So first of all, penalizing people for saving money may not directly lead to more spending. So people may opt to pull the hard cash out of the banks and just hold onto it, right? Why go out and spend? If you're being penalized for holding onto it, maybe just leave it under your mattress. Secondly, banks would not like this at all. So bank revenues are built on interest rates that are collected on loans, and then bank expenses include interest that's paid on deposits. That model gets turned upside down in negative interest rates, which could actually squeeze bank margins. And third, if there is a higher demand as a result of more lending, what will happen to home prices? What if everyone is then bidding for that Studebaker that Adam wanted because everyone is now being penalized for saving cash? That may drive the price of the car itself up. Adam's looking at the car right now. That's the Hialeah Green right there, by the way. Now, could it spill over into an asset bubble that pops in that case? What if all those car prices end up exploding? What about equity prices? Well, that's definitely a concern. But for right now, here in the United States, we are currently above negative. So we're under 2%. But again, this is the concern. We're not that far away. The problem is that the Fed has historically needed about 5% of interest rate drops. In the 90s, we saw it in the dot-com bubble, and then we also saw it in the great financial crisis. They needed that 5% of easing to actually handle a downturn. So does that mean that we're going to go negative? If we're at 1.5 to 1.75%, we don't have a lot of room. Now, the Fed has said it'll rely on quantitative easing and forward guidance first, but honestly, who really knows? So unfortunately, guys, it's not as easy as President Trump illustrated in that 17-second clip that we just played for you, but it's definitely something worth watching in the central banking space for the years to come.
Brian, thank you very much, as always, for explaining that for us.